Hello, my friends. So, as a basically expected as of yesterday, I was looking to buy those puts, the long puts. Towards the end of the day, we had the opportunity, to sell early in the day. So what I did is I sold against those puts, right? I sold against the 475s yesterday at 460 when we were down here, and then I sold against 460 or 473s right around here. I just now have bought back the short puts, so I'm all long puts again. I bought back the short puts and I took in a nice little chunk. So the cost of those long puts substantially cheaper now. I basically took back like 50% of the cost of those puts. We'll likely see another two pokes through this level over here. This level right here, 467.96-ish. Probably poke through that one more time. Once or twice. And then we have a decline from that, and that'll be a sharp decline. I'm thinking probably starting right around now, or starting within the next, starting before, let's say, 2 o'clock. Looks like we have a high in the early morning tomorrow. That is it higher than today's? Hard to determine at this point, but I will point out one thing, guys. So you see how I marked this line, this price level here with science? It appeared on January 7th and on January 10th. Check it out. When we look at January 10th, we had the science card in the pre-market. So let's go to January 10th. Pre-market, bam. And then on the 7th, we had the science card at roughly, let's say, what was it, 11 to 12-ish? This is 11 to 12-ish, or 12, well, here's 12. But boom, there's the science card one more time. So you can see what I mean by you're able to determine price levels based on some of these technical cards as significators. There's another one that I'm going to be keeping an eye on. That's the peace card, which we saw yesterday in the post-market. And then again, we'll see it midday on Wednesday. And then as the low on Thursday. Well, not necessarily the low, but we'll see it again on Thursday and again on Friday. Interesting. That likely means there's quite a bit of volatility, because I do see some sharp downs. And if we're reaching the same level multiple times, that indicates a lot of volatility. So that's where we're at, guys. I'm looking for that next decline. And likely what I'll do is I'll sell against those puts again and start taking in a profit, because the 470s, 475s, all those are like super juicy right now. So as we go down, I'll sell against them when I expect this to turn around and go up, and then I'll collect what I sold, the difference between what I sold and what I buy it back for. That's a short position. So, and that'll, every time I do that, it'll decrease the amount that the long position cost, provided that I time it correctly. I actually had a few positions on, let me see here. So right now I have a diagonal spread, 464 puts and 462 puts expiring on the 14th and the 18th. So the 464 is on the 18th, the 462 is on the 14th. And I basically paid almost nothing for the position. It's a $2 spread. So to pay nothing for it, it's basically like no risk, and I have the possibility of making $2 per contract. In a lot of cases, if you time the legs properly, which you can only do if you can time the market, which they say you can't do, even though clearly you can. So if you hone your skill and you time the market utilizing SO meta-analysis, you'll be able to put on vertical spreads a leg at a time and actually get paid to put on a vertical, what should have been a debit spread. You'll turn that vertical debit spread into a credit spread by putting it on in two spreads. So two legs. So you put the first leg on, you buy the long position, the market moves in your favor, then you sell against the long position at a not as good strike price, and you basically have locked in. You can't take any more of a loss basically you've locked in, if the contracts expire in the money, then you get that spread. But because you put it on one leg at a time, you actually made a credit while putting it on. So you got paid for the possibility of taking in another profit, basically. I love doing that. You can only do that if you can time the market, guys. I don't know how else you would do that except with SO meta analysis. I don't know how you would do that successfully except with SO meta analysis. So yeah, guys, that's where we're at right now. Hopefully everybody's been following along. We're doing pretty well here. Took in a bunch of profits. And now we basically just shaved off almost all of the cost of the puts that we have right now, with minimal risk on the table. All right, guys, that's where I'm at. Look out for a decline. When we look at the 1 month, guys, it's very eye-opening. Let me see here. So we have opportunity here. This is something's going on with Congress, I presume, right now, based on the Hierophant card here. I don't watch the news. It's toxic, guys. Totally will fuck up your trading. So in any case, that unicursal, that's an opportunity to open puts or protect against long positions just prior to a sharp decline. And we have an inverse Aeon card and an inverse victory card for Wednesday, the correlation to each other. There's probably a very deep decline in the next 2 days, guys. So I'm utilizing this opportunity. What I did is I sold against my long puts, collected the difference between what I sold it at and what I bought them back for, and then reduced the cost of my long puts substantially, if not completely, in preparation for more of a downturn, guys. All right, that's where we're at, guys. Let me know what you think. Let me know how you're doing. Love to hear from you guys. Thanks for watching. Don't forget to like and subscribe, guys. And I'll see you all later.